If you've looked at the housing market lately, you already know the math feels broken. Between skyrocketing asking prices, climbing property taxes, and rising insurance premiums, the cost of simply keeping a roof over your head is accelerating. To understand exactly how tight the market is, we need to look at this baseline chart from the Federal Reserve. It maps housing affordability. If a household is spending 30% of their income or less on housing expenses, it sits right here in the safe zone, what's historically considered affordable. Right before the peak of the 2006 bubble, Americans were spending 44% of their income on housing. When the market crashed during the Great Financial Crisis, that number dropped to 25%. That shift created a period defined by low prices and sub-4% interest rates. But the most recent Federal Reserve data shows a sharp return to those previous highs. We are now back up to 42% of household income going straight into housing costs, putting current affordability within 2 percentage points of the 2006 peak. Wage growth has not kept pace with home prices or the mounting costs of maintenance. The housing market has moved away from historical affordability norms, which means the old rules for when to buy no longer apply. The primary driver pushing us to that 42% threshold is the sheer cost of borrowing. The average rate on a 30-year fixed mortgage has climbed past 6.5%, actively hovering year 7. It's a harsh reality for buyers holding out hope for the 3 or 4% interest rates that were standard just a few years ago. This creates a paralyzing dilemma. You either buy now and accept a heavy monthly interest burden, or you wait for rates to drop and risk the base price of the home climbing entirely out of reach. Depending on your timeline, you are facing one of 3 paths. You are a prospective buyer trying to enter the market, a current homeowner looking to refinance, or a speculative investor looking for an entry point. Waiting for a return to sub-4% rates requires banking on a specific set of macroeconomic shifts. Navigating the market successfully today means understanding exactly why rates aren't moving. To figure out where mortgage rates are headed, you have to watch global energy supplies. Geopolitical tensions, like the ongoing conflicts involving the US and Iran, create direct volatility in the oil and gas markets. When energy becomes more expensive, the cost to manufacture and transport almost every single consumer good goes up. This physical reality drives up broad inflation expectations across the entire economy. This chart shows how those expectations dictate your mortgage. Mortgage rates closely track the 10-year Treasury yield. As inflation expectations push higher on the x-axis, the yield climbs right along with it. This upward momentum on the 10-year yield forces mortgage rates into a high floor. No matter how perfect your personal credit score is, you are bound by this macroeconomic baseline. On the y-axis, we have the opposing force. The Federal Reserve steps in to try and lower rates through monetary easing or directly buying U.S. Treasuries, pushing down against that inflation pressure.
You have one force pulling rates up and another trying to push them down. They cancel each other out, trapping the housing market in a range-bound state. For the foreseeable future, we are stuck drifting between 6 and 8%. Because of this trap, many prospective buyers are choosing to sit on the sidelines, holding cash, simply waiting for interest rates to drop before they buy. The logic makes sense on paper. Securing a lower percentage rate directly reduces your future monthly interest payment. But you cannot look at interest rates in a vacuum. This diagram illustrates the strict inverse relationship between interest rates on one side and home-based prices on the other. The moment rates actually drop, the massive wave of buyers who have been waiting on the sidelines will flood back into the market all at the exact same time. That sudden surge in buyer competition causes sellers to aggressively hike the base asking price of their homes to match the new demand. Sitting out is a zero-sum game. If you wait, you avoid the high interest costs of today, but you guarantee that you will pay a significantly higher base price tomorrow. If you already own your home and you're feeling the squeeze, your priority is likely finding a way to refinance and lower your monthly burden. In this range-bound environment, a standard refinance at 6.5% might not provide the relief many are looking for, especially once closing costs are factored in. For those already at 7%, the math rarely justifies the move yet. The major wildcard that could break this trap is the arrival of the new Federal Reserve Chair, Kevin Warsh. We don't yet know exactly how aggressive he will be with the Fed's balance sheet. The math only works in your favor if Warsh initiates an unexpected emergency monetary policy shift that causes interest rates to temporarily plummet. Until that happens, hold your ground. Endure your current rate, save your capital, and wait strictly for a macroeconomic event to cut rates significantly before you sign new paperwork. For the speculative investor, the current range-bound market offers a difficult path. When prices and rates move in opposition, the risk of capital loss often outweighs the thin potential for a quick gain. But if you are buying a primary residence and plan to live in it for 5 years or more, your calculus is entirely different. The clear strategic advantage of buying today is locking in your base price now before any future rate cuts trigger a massive surge in asking prices. The process will be grueling. Finding a home that fits your budget in this environment isn't quick. It will easily take you 6 to 12 months of active shopping to find a fair deal. The payoff for enduring this process is time in the market. Over the next half-decade, you allow inflation to work for you, passively building property equity while you live there. Yes, housing currently demands 42% of an average household income, but for a primary resident, stepping into the market today and securing your base price is mathematically safer than waiting for a tomorrow that will be inversely more expensive.